Welcome to Mortgage Map. You have negotiated a purchase price with the seller, your mortgage application is in process, and you are moving steadily toward closing. But then, your lender delivers some stressful news. The home appraisal has come in lower than the agreed-upon sales price. For many buyers, a low appraisal feels like a roadblock that will automatically ruin the entire purchase. However, a low appraisal is a common situation in real estate, and there are established pathways to handle it. Lenders will not loan more than a home's appraised value, which creates a financial gap that must be resolved. Today, we will explain exactly what happens when an appraisal comes in low. We will break down how lenders use appraisals, the options available to bridge the price gap, and how you can protect your down payment using real-world examples. Let us first examine why the appraisal matters and how a low appraisal affects your mortgage financing. An appraisal is an unbiased estimate of a home's fair market value conducted by a licensed professional appraiser. Lenders require appraisals to protect their financial investment. The home serves as collateral for the mortgage loan. If you default on your payments, the lender must be able to sell the home to recover the outstanding debt. Therefore, lenders use the lower of the purchase price or the appraised value to calculate your loan-to-value ratio, or LTV. For example, if you contract to buy a home for $300,000 and plan to put down 10%, your down payment is $30,000, and your loan amount is $270,000. If the appraiser agrees the home is worth $300,000, your LTV is 90%, and the loan proceeds smoothly. However, if the appraisal comes in low, say, at $280,000, the lender will no longer base the loan on the $300,000 purchase price. Instead, they base the 90% loan on the appraised value of $280,000. This means the maximum amount they will loan you is $252,000. Since you still owe the seller $300,000 under the purchase contract, the original 70% financing no longer covers the purchase. The original $30,000 down payment, plus the new loan amount, leaves a gap of $18,000. This gap represents the difference between the contract price and the appraised value that you must resolve. Without resolving this difference, the lender will refuse to approve the mortgage, leaving the contract in a state of suspension until a formal agreement is reached between the parties. Second, let us analyze the primary ways to bridge the financial gap created by a low appraisal. You generally have four options to resolve this issue. The first option is to negotiate a price reduction with the seller. If you have an appraisal contingency in your contract, you hold the leverage. You can ask the seller to lower the sales price to match the appraised value. Many sellers will agree to this, especially if they have already moved or want to avoid putting the home back on the market, where other buyers will face the same appraisal limit. The second option is for you to bring extra cash to the closing table. In the example of the $18,000 gap, you could pay the seller the difference out of pocket. This money is paid in addition to your original down payment and does not go toward reducing your loan balance. The third option is to meet in the middle. You and the seller can agree to split the difference. For example, the seller lowers the price by $9,000, and you bring an additional $9,000 in cash. The fourth option is to dispute the appraisal, which is known as a rebuttal of value. Your real estate agent can submit recent comparable sales that the appraiser may have missed or point out errors in the appraisal report, such as incorrect square footage or omitted home improvements. While successful rebuttals are rare, they can sometimes convince the appraiser to adjust the value upward. If none of these options work, and your contract contains an appraisal contingency, you can cancel the contract. This contingency allows you to terminate the agreement and receive a full refund of your earnest money deposit, protecting you from being forced to buy an overvalued property. Finally, let us discuss how a low appraisal can impact your long-term mortgage insurance and how to plan for this scenario. If you decide to pay the appraisal gap in cash, you must understand how it affects your equity. Paying an extra $18,000 in cash to purchase a home appraised at $280,000 means you are paying more than the home is currently worth on paper. You start homeownership with negative equity, which can delay your ability to refinance or sell the home for a profit. Furthermore, if you cannot afford to bring extra cash, you might consider restructuring your loan. For example, instead of putting down 10%, you could switch to a 3% down payment loan. This adjustment frees up cash to cover the appraisal gap, although it will increase your monthly payment because you will have a larger loan balance and higher private mortgage insurance costs. To navigate a low appraisal successfully, follow 3 simple steps. First, consistently ensure your purchase contract includes an appraisal contingency. Second, keep a cash buffer in your budget so you are not completely drained if you need to cover a small valuation gap. Third, consult your lender immediately to model how different down payment structures will affect your monthly payment. By staying calm and understanding the math behind the valuation, you can handle a low appraisal objectively and protect your financial interests. Ultimately, an appraisal is a protective guardrail for you just as much as it is for the lender. It prevents you from overpaying for a property in a heated market. By viewing a low appraisal as a tool for negotiation rather than a transaction failure, you can make a rational, data-driven decision about your home purchase. Mortgage Map is a calm guide for first-time buyers and curious homeowners navigating the home buying process. The channel explains down payments, interest rates, closing costs, pre-approvals, refinances, loan types, and common mistakes with real numbers and simple visual examples in plain English without financial advice or market hype. This video is general mortgage education, not financial, investment, legal, or tax advice. We are not a lender and do not recommend specific loan products. Mortgage programs, rates, and terms change frequently. Consult a licensed mortgage professional before making financial decisions.